Welcome to the final episode of Investment Blueprint for Passive Investing. In the previous episodes, we've taught you everything that has led you to understand who you are as an individual, what your risk profiles are, how do you want to go about investing for your future goals. But we've also taken you through a lot of products and services that are offered by a lot of AMCs today, so help you navigate how to build a portfolio for yourself. And this episode is important because we are going to tell you how exactly should you go about investing in them, basis understanding who you are as an individual. So for those reasons, this is a very important episode, and I would request everyone to stop, pause this video and call your friends or share this video with them so that they can also embark upon this journey. We have none other than Mr. Pratik Oswal, who would be helping us along the way. Thank you, Pratik, for being a part of the show. And the 9 episodes went by very quickly. I think the 10th episode would go as amazing as the first 9. So thank you very much and welcome to the show. How's your experience so far on the first 9 episodes?
It's been fun. I personally, if you look at, I think one of the big things that someone from the asset management business does is education.
Yes.
So I think this is a great opportunity for us to do what we're supposed to, which is educate people on investing, on what they should and should not. So I think this has been a great platform. Thank you.
Definitely, and I think it becomes more important for first-time investors to actually understand what we're coming with. With the advent of so much content and so much information that's coming on your TV, mobile and laptops, that it becomes even more difficult for people to understand what means what. And I think this platform will allow people to understand themselves and take decisions accordingly. I want to start today's episode by actually looking out for the first-time investors. I know the problems that a first-time investor go through because I was a first-time investor some time ago as well. And I realized that there was a need of like some hand-holding, some advice in terms of, how to go about doing things, So in such a context, I just want you to come out and tell your experience or share your wisdom about how should first-time investors should look at this opportunity and go about investing for themselves.
Yeah, no, thanks. Most first-time investors, unfortunately, make a lot of mistakes.
Yes.
I think I would say, and that's partly because there's just so much content out there about investing. There's so much, I think.
FOMO, as we call
FOMO,
it.
of trying to invest in the right asset classes.
Yes.
So, we'll obviously talk about the don'ts of investing, and those are very important. But I think, the most important thing in investing is at least, and while we're here, we talked about the different asset classes. We talked about, how to combine them into building asset allocation solutions.
Yes.
I think I think that which is even more important to that is to invest early.
Yes.
I think the power of the reason why you will build wealth is not because of prices going up. Investing is because you have to give your investments time to grow.
Yes.
And the problem with the first-time investor is that the first 5 years is extremely slow, and I think it's a very investing is a very boring process.
Yes.
They say that investing is like watching paint dry.
Yeah.
And if it's exciting, then there's a good chance that you're actually doing something wrong.
Yes.
So investing is unfortunately very boring. It's like watching paint dry. And the first 5 to 10 years of investing is very slow and not much is happening.
Yes.
But
your
if you
portfolio is also very
small, and they're growing at say 5, 15, 20%, 10, 15, 20%.
Yeah.
But what you see over time is that compounding kicks in.
Yeah.
So the money that you've invested today will grow at 10, 15%.
Okay. Yeah.
That same amount invested today.
Yes.
And I think that is why investing in early is very important.
So time in the market is very important.
So time in the market. So I think I would say that, Warren Buffett, for example,
yes.
To give an example, he started investing at 11.
Yes.
So it took him, and he became a billionaire by 55.
Okay.
So he went from 0 to 1 billion at 55.
Yes.
And from 1 billion to 100 billion
yes.
At about 75, 80.
Okay.
So what took him 40 years,
yes.
took another 20 years to go 100x.
Yes.
And the rate of return is exactly the same.
Yes.
So I think power of compounding is the most important,
yes.
I would say, thing. And it's very important for customers to get in early,
yes.
and think long term and be patient for the investments to grow the long run. That's one. Second is passive funds. I think one of the biggest, at least for our younger audiences, what I've seen is there is a lot of demand for products that are very high returns.
Yes.
So products that have delivered
Get rich
25%,
quick.
30%
Yeah.
returns over the last 3-4 years. There is a lot of pile on in those sort of investments, and I
Yes.
think that is a very bad way of investing.
Yes.
I think if you ask any investor, buying funds that have done very well in the past is not a very good strategy, because it's very difficult for consistent performance.
Yes.
If you look at the last 3 years,
Yes.
the fund that delivered the most returns is say 35-40%. If you look at 5 years, it's gone down to 25. Look
Yeah.
at 10 years, it's gone to 20. Look
Yes.
at 20 years, look at 10 to 15%.
Yes.
So I think you should really look at attributes that are outside returns.
Yeah.
To really I think choose your investments.
Yeah.
So that's somewhat very important, and also don't focus too much on on fund selection.
Yeah.
As I said, asset allocation is very key. So you should
Yes.
know how much of your money you want to invest in this versus that. So I think these are, and which is why I think passive funds are extremely good, because there is no bad performance. For a first-time investor, they can build a simple portfolio
Yeah.
of equity, debt, international commodities, just with passive funds.
Yeah.
And guess what? There's no bad performance in a portfolio. You're having very low costs, and
Yes.
we know that the long-term performance of passive funds are very good.
Yeah.
So I think for a beginner investor who does not really know how to navigate the system,
Yeah.
to enter in early, they can use a very very simple passive portfolio.
Makes sense.
So and I think not get swayed by some of the high return products, because inevitably I think what we've seen is that the investors who end up coming in these high return products end up really destroying wealth.
Yes. A lot of newcomers also hesitate to jump into the market. I think, like you rightly said, that Nifty 500 or something as big as that would be like a good step for them to get in. But one of the also problems I was thinking of is that I thought myself to be a certain investor, whereas I am not. Like, my personal journey of learning how to invest has been discovering who I am as a person is not how I am as an investor, right? So I was in a big phase of dissonance. I used to think I'm very aggressive, whereas I think today I will consider myself very moderate. And depending on what your needs and wants are, I realized that my investments could have been optimized and whatnot. So in similar way, could you talk about what are the different types of first-time investors could be there, and how should one view themselves as investors so that they have benchmarks to look after?
Yeah.
So if there is like a conservative and a moderate, what are the other profiles that you would say that individuals or anybody else can benchmark themselves against and go about investing?
Yeah. So I think very important, your risk profile determines your allocation.
Yeah.
So I think knowing your risk profile is important.
Yes.
And what we've seen is that a lot of investors tend to change their risk profile.
Yes.
They need to start off with conservative and then become aggressive.
Yeah.
Or they start off with aggressive and become conservative. A conservative investor will ideally feel left out in a bull run.
Yes.
The markets are doing very well.
Yes.
An aggressive investor will feel that they've lost a lot of money in, say, like a crash or something, which happens all the time. And what I've seen is that normally conservative investors tend to sort of go towards moderate investing.
Yes.
And aggressive investors tend to sort of again lean towards moderate investing.
Yes.
So essentially, let's understand the difference between these three.
Yes.
A conservative investor would put maybe less than half of their portfolio in equities, which is the highest risk asset class.
Yes.
Also, the asset class with the highest returns.
Okay.
A moderate investor would put roughly half their money
Okay.
in equities. An aggressive investor would put obviously more than half of their capital, of their money in equities.
Okay.
So obviously, an aggressive investor. So we, at least what I've seen, is that conservative investors are investors. If you are an investor
Yes.
that does not like sort of huge or even moderate short-term drawdowns,
Yeah.
so if you don't like losing 15, 20%, even like if you're not comfortable with any sort of drawdowns,
Yeah.
short-term drawdowns,
Yes.
obviously, long-term markets end up doing well, then you're a conservative investor.
Yeah.
If you're an investor that really does not care of drawdowns,
Yes.
they're okay losing 50-60% also,
Hmm.
obviously on a short-term basis, then they're aggressive investors.
Yeah.
But I believe that most investors tend to be in the middle,
Yes.
whereas they're not sure whether they'll want to lose money or not. So I think moderate is where I would say. So if you don't know where you are, I think moderate is where you should be.
Okay.
If you want protection of your capital at all times,
Yes.
go to conservative. if you don't care about if you don't care about losing money in the short term, then
Yes.
you're an aggressive investor.
But within that also, like you mentioned, that somebody who's a conservative may have less than 50% into their equity.
Yeah.
But now we've learned so many products now, right? And how do you think, are they taking more chances because they have lesser exposure to equity, or are they, like looking out for, will we have segregations in those profiles as well?
You could have segregations, but I think these three are very simple.
Okay.
You could have a lower than conservative,
Okay.
or which is extremely, I would say, like an income investor.
Okay.
You can have a hyper aggressive investor. But I think this is a very simple framework to use
Okay.
for most investors.
Yes.
Are you conservative, aggressive, or moderate? Most investors tend to be moderate.
Okay.
So I think in terms of behavior, if you don't know what you are, I would say stick to moderate. That's
Yeah.
very simple. Put about half your money in equities,
Yes.
and half in other asset classes,
Yes.
like commodities or fixed income, or
Yes.
so I think that's how most investors should do, at
Okay.
least to start up their portfolio. And within the allocations, you can look at passive funds.
Okay.
Within the equities, you can look at a Nifty 500 fund.
Yeah.
You can look at a mid cap 150 fund. You can look at a factor fund. In fixed income, you can look at any sort of good fixed income fund.
Yeah.
In gold, you can look at gold and silver. And international, you could, if you are leaning towards passive,
Yeah.
then you can go for an S&P or Nasdaq fund. So I think you have very simple funds
Yeah.
out there. And yes, people would say that I want to make 25% returns. So I will not go for passive. I will go for buying the right fund.
Yeah.
I think it's very tough in reality. Reality, I have almost in my 10 years experience never met anyone
Yes.
who's really made outsized returns.
Yes.
In fact, most people have lost money, underperformed,
Yeah.
because they are going for their outside returns.
Yes.
So there's a study in the US that talks about the fact that an average investor
Yeah.
ends up making about 4 to 5% less
Okay.
than the index also.
Okay.
Why? Because they're gunning for greatness.
Yes.
And I think in investing, you should have expectations. I would say most investors should expect equity funds to deliver about 12 to 15%.
Yeah.
It's good expectations. I
Yeah.
think if you're expecting 25, 30%, then I think you are probably, I think
Unrealistic.
unrealistic.
Yes.
And I think anyone out there who's trying to sell you on those expectations is also, not doing the right thing.
Yes.
So I would say that you should have expectations that are realistic.
Yeah.
And you should build your portfolios according to that. So if you are okay with, say, 10%, you can look at a moderate portfolio. If you
Yeah.
want 15%, you can go for an aggressive portfolio.
Yes.
But then you also have to, withstand the volatility that comes with
Yes.
it.
I also noticed that in the attempt of getting the set 25% returns, people look at opportunities very differently. So they'll get this one-time opportunity, and irrespective of being conservative, moderate, or aggressive, people tend to lash on very aggressive on the upcoming opportunity, right? So if a theme comes in,
So I think the one of the biggest, and this is one of the don'ts
Yes.
of investing, is that if you are investing in something that everyone is investing in,
Yeah.
your results will be average,
yes,
right? So I think FOMO is one of the biggest wealth destructors of our
Yes.
time. So whenever you're investing in something, you should ask yourself, are there a lot of people investing in this, and why are they investing in
Yes.
this? Is it because of some craze? And
Yeah.
I would say
Some noise.
saying no
Yeah.
is the most difficult thing in investing, but it's
Yes.
extremely important.
yes.
So I would say whenever you are looking to invest, ask yourself, am I investing because of FOMO?
Yeah.
And if you are, then you should avoid it.
Yes.
I think it's very difficult decision to say no.
Yes.
If you want to invest in it, maybe you can look at allocating a very small part of your portfolio to it.
Yes.
Maybe start an SIP.
Yes.
That could be a good way of avoiding FOMO.
Yes.
But I would say don't put all your capital there, and
Yes.
because what we've seen is that people who end up I think investing in these fads
Yes.
end up losing a lot of money.
Definitely.
And I think compounding breaks.
Yes.
So the formula of compounding breaks if you lose capital.
Yes.
So the number one rule is to not lose money.
Yes. Protect your
and
capital
protect your
at all.
capital, and that will happen and this is obviously if you are sitting on a drawdown, that's losing capital.
Yes.
Losing capital happens when you sell.
Sell. Yes.
So don't lose money while selling.
Yes.
That's rule number one. Rule number two is don't forget rule number one.
Okay.
So that's very important. So again, don't invest in fads.
Yeah.
And if you want to invest in, maybe do a very small allocation to it.
Yes. Makes sense. Makes a lot of sense. I know a lot of people personally who heard a lot about something coming up and then they
Yeah, I mean,
allocating a lot of money.
you had cryptocurrency, you have
Yes.
NFTs, and you have a lot of fads
Yes.
that keep happening every 2 years.
Yes.
And I think having an asset allocation, as I said, is great because it keeps you very disciplined.
Yes.
It keeps you outside the fads.
Yeah.
You have an allocation, you have your funds. All you're doing is investing in those funds.
Yes.
You're not sort of looking at the fads,
Makes sense.
which there's a high probability that fads will lead to losing money.
Yeah. You famously mentioned one of the don'ts that you say. I'm pretty certain in your last 10 years of experience, a lot more don'ts that you've accumulated together, I guess, along with the new to market
Yeah.
investors, people like me and everyone will, benefit. Are there like a list of don't do's that you personally follow that you would like to recommend to all our viewers today?
Yeah, I think I talked about not following fads.
Yes.
That's a very important don't. I said keep your expectations realistic.
Yes.
That's very important. I said keep your risk profile consistent.
Yes.
If you are moderate, stay moderate.
Yes.
Don't like investing is a very emotional game.
Yeah.
So people tend to take outsized risk in
Yes.
good markets and
Yes.
and less risk in bad markets.
Yeah.
That's again very bad for you. So
Yeah.
keep your risk consistent
Yes.
in your portfolio. As I said, I think make sure that you're disciplined enough to invest
Yes.
at every interval.
Yes.
I think one of the best ways of investing in equity markets today is through an SIP.
Yeah.
I also invest through an SIP, so I think it's a very good way of investing in good and bad times.
Okay.
So I think one of the don'ts is don't overinvest in good markets and underinvest in bad markets.
Okay.
Invest consistently and continuously.
Yes.
And I think it makes sense to have an asset allocation.
Yeah.
And make sure that you are continuously rebalancing your portfolio
Yes.
every year or so.
I wanted to ask this question to you. What's your view on the growth story of India and where we are going from here? We hear a lot about, our indices to reach a specific number, over and over again. Do you think this growth story will also impact or convince people to be a part of this investing journey?
Yeah, I think definitely. I think obviously India's growing at a fantastic. I mean, I think the growth story has been intact for the last 20 years.
Yeah.
And I think it will continue to be intact. So I think anyone looking at equities
Yeah.
should be very excited.
Okay.
Very excited to invest. Very excited because we have a huge growth expectation coming up over the next decade or so.
Yeah.
And I think regardless of, I think unlike the world,
Yeah.
I think now India is I think pretty much one of the only countries where there's good amount of growth
Yeah.
and stability. So I would say that we're looking, at least most people are expecting very good times going forward.
Okay.
I believe that everyone should be wealthy.
Yes.
And it's almost impossible to be wealthy on a salary.
Yeah.
Increase in salary will probably lead to increase in your lifestyle or your quality of life.
Yeah.
But financial independence comes from ownership.
Yes.
You have to own, say, real
Assets,
estate
yeah.
or own gold or own stocks.
Yes.
So I think in terms of ownership, and in terms of wealth creation,
Yes.
it's an excellent segment.
Yeah, passive
people to-
investments is basically taking away all the excuses that anybody has to not start investing, I would say.
Absolutely.
Yes.
That is, it makes life simple for
Yes.
investors, and I think it also makes it easy for people to enter.
Okay.
So we believe that ownership is very important for wealth creation,
Yeah.
and the earlier you start ownership, the
Yes.
better it is,
Yes.
and that's why you should own today.
Awesome. So for today's episode, we would want to have a task as well, because now the final structure is people are now wanting to build their own portfolio. So while making a portfolio, would you want to direct them to do a certain task and make a sample portfolio and share it in our comment section?
Yes, absolutely. So I think the task for today would be to take all our learnings. We talked about building blocks, we talked about asset classes, we talked about asset allocation, and we talked about the don'ts of investing.
Yes.
So I think now it's time for a lot of our viewers to share what they think are good portfolios for them to invest in. You
Yes.
can invest in, I would say, a maximum of, maybe 6 to 7 mutual funds. I
Yes.
think investors should not go beyond that.
Yes.
And I think you can share what your allocation to
Yes.
these mutual funds would be and how often you would rebalance them.
Yes.
So I think that could be a good way of, I would say, ending this 10-part series.
Yes. So thank you very much for being a part of this. I hope by the end of this, your friends, family, everyone who you shared the video with have also embarked this journey. And we're looking forward to create more such content together, helping you take better investment decisions. Thank you very much for your time. Looking forward to seeing you in the next project that we do together. Thank you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.